Oke, selamat pagi pada Bapak Ibu sekalian, rekan-rekan dari PAI. Salam sejahtera dan selamat datang di webinar PAI sesi ketiga dengan topik untuk measurement in IFRS 17 General Insurance. Ini adalah sesi terakhir. Kita sudah melalui 2 sesi sebelumnya, di mana topik sebelumnya adalah LIC dan LRC using GMM ya. Dan topik untuk hari ini kita akan membahas LRC using PAA atau Premium Allocation Approach. Sebelum perkenalkan dulu, nama saya Roni Tanzil dari General Insurance. Oke, untuk metode untuk materi hari ini mungkin PAA ini metode yang untuk di Indonesia teman-teman khususnya di GI kita ingin coba menerapkan ya utamanya karena lebih simpel ya konon katanya. Jadi harapan ini akan menjadi materi yang sangat berguna, sangat penting untuk penerapan IFRS di tahun 2025 nanti, khususnya di Indonesia, dan juga bagaimana untuk mengimplementasikan PAA Eligibility Test yang akan dibagikan oleh teman-teman narasumber kita. Sebelumnya, saya juga ucapkan selamat datang kepada tim dari Nicholas Actuarial Solution yang akan menjadi narasumber kita hari ini. Untuk Nicholas, Billy, Jesse, thank you for participate for your availability to be a contributor for our today's event. Sekarang sebelum kita mulai, saya akan membacakan beberapa peraturan untuk acara hari ini. Pak Yosef, Pak Lili, boleh di-share? Ya, pertama untuk nama, harap teman-teman Bapak Ibu rename dengan format nomor strip nama. Nomornya telah di-share oleh Pak Yudi melalui WhatsApp atau melalui email ya. Jadi ada nomor absen di Bapak Ibu di sana, nomornya strip nama Bapak Ibu agar kita mudah untuk melakukan validasinya. Lalu yang kedua, form presensi harap diisi dan feedback akan melalui link yang akan dibagikan melalui chat selama acara berlangsung nanti. Poin ketiga, untuk acara jalannya webinar, untuk Bapak Ibu, kamera dan mic seluruh peserta tolong dinonaktifkan. Lalu untuk keempat, pertanyaan dapat disampaikan melalui chat atau dalam sesi tanya-jawab. Jadi nanti Bapak Ibu boleh menyampaikan melalui chat dulu dalam bahasa Indonesia atau bahasa Inggris, nggak apa-apa. Nanti saya akan membacakan pertanyaan di sesi akhir. Kalau Bapak Ibu juga ingin bertanya secara langsung, boleh juga disampaikan melalui chat terlebih dahulu. Nanti saya akan mempersilahkan untuk Bapak dan Ibu untuk menyampaikan pertanyaan atau komentarnya. Yang terakhir, di sesi akhir akan ada dokumentasi. Diharapkan seluruh peserta mengaktifkan kamera di saat itu ya. Nanti kita akan melakukan foto bersama lagi untuk sesi ketiga ini di akhir acara. Itu untuk peraturan hari ini. Kemudian untuk materi sudah dibagikan melalui link yang dikirim oleh panitia kemarin, baik itu melalui WhatsApp ataupun melalui email. Silakan Bapak Ibu download untuk kita gunakan selama acara workshop ini berlangsung. Materi 2 pertemuan terakhir yang sesi pertama dan sesi kedua juga sudah di-share, termasuk file Excel yang sudah ada formulanya ya. Jadi Bapak Ibu bisa ambil dari sana langsung, di-share folder yang sana. Oke, sekian untuk pembukaan dari saya. Selanjutnya saya akan switch ke English. Saya akan membacakan beberapa CV untuk narasumber kita hari ini. Now I will switch to English and I will read our speaker's resume for today. The first speaker is Billy. He has experience in implementing IFRS 17 in general insurance company in Malaysia, and also creating a PAA eligibility testing model for a general insurance company to use. We know Billy is Indonesian. He's been a speaker in the last 2 sessions as well. And the next one is Nicholas. He has over 15 years of experience in actuarial work, including life insurance, family takaful, general insurance, general takaful, employee benefits, pension, medical insurance, reinsurance, and insurtech startups. He has developed various technology and software application, including IBM robot, PACC, PAA robot. Outside of the traditional work, Nicholas has significant experience in captive insurance, offshore insurance, artificial intelligence, and data analytics. And the last one is Jessie. She has 2 years experience in actuarial valuation for multiple institutions involving in GI and reinsurance. She has led various actuarial valuation projects in Malaysia, Cambodia, and Papua New Guinea, involved in reviewing and building in-house IFRS 17 PAA specialist software or PAA robot. Previously, she seconded to a large accounting firm for IFRS 17 implementation. So welcome again to Nicholas, Billy, and Jessie. Now I think Billy will start today's webinar. So the stage is yours now, Billy.
Ya, thank you Pak Roni. Ya, selamat pagi Bapak Ibu semuanya. Ya, untuk yang belum mengikuti sesi 1 dan 2 sebelumnya, ya perkenalkan lagi, nama saya Billy. Saya Actual Analyst di Nicholas Actual Solutions. Ya, saya berasal dari Indonesia. Jadi sesi saya bawakan dalam bahasa Indonesia ya selama 5-10 menit ke depan. Oke, let me share my screen. Ya, oke. Ya, hari ini seperti sesi-sesi sebelumnya, fokus kita adalah untuk memberikan materi di measurements in IFRS 17 for general insurance. Hari ini sebagai sesi terakhir dari kita akan membawakan liability for remaining coverage for premium allocation approach. Ya, jadi hari ini seperti yang Pak Roni sudah jelaskan, PAA itu yang bakal di-prefer ya sama perusahaan asuransi umum pada umumnya. Jadi semoga topik yang kita bawakan hari ini akan sangat bermanfaat untuk Bapak Ibu semua ya. Ya, untuk hari ini saya akan membuka selama 5 menit ke depan. Lalu akan dilanjutkan oleh Jessie. Dia akan menjelaskan cara mengisi jurnal dan balance sheet untuk Rrc PAA for one account. Lalu akan dilanjutkan oleh Nicholas. Nicholas akan menjelaskan 2 topik, yaitu cara menghitung Rrc PAA untuk one portfolio dan cara melakukan PAA eligibility testing, tes kelayakan PAA. Ya, jadi seperti sesi-sesi sebelumnya, kita hanya akan fokus di measurement. Kita nggak akan membahas combination and separation, level of aggregation, recognition, modification and recognition, presentation and disclosure, kita nggak akan bahas. Kita cuman akan bahas cara menghitung liabilitas kontrak asuransi. Di sesi 1 kita sudah membahas liability of incurred claims, yaitu liabilitas untuk klaim yang sudah terjadi, yang sudah lampau. Dan di sesi 2 dan 3 kita membahas liability of remaining coverage, yaitu liabilitas untuk sisa masa pertanggungan. Ya, di sesi 1 kita udah tahu cara menghitung LIC. LIC itu hanya fulfillment cash flow dan risk adjustment yang kita pakai untuk menghitung case reserve plus IBNR. Di sesi kedua, kita sudah membahas cara menghitung LRC GMM. LRC GMM itu dipakai untuk asuransi jiwa atau asuransi umum yang long term. Jadi, seperti yang sudah saya bawa di sesi 1 dan sesi 2, example yang paling mudah itu kalau Bapak Ibu beli asuransi mobil, pas beli mobil baru kan ada cicilannya tuh. Nah, biasanya asuransi mobilnya akan disesuaikan dengan jangka waktu cicilannya. Nah, itu akan membuat, contoh kalau cicilannya kayak 3 tahun, itu bakal membuat asuransinya, kontraknya itu 3 tahun durasinya. Nah, selama 3 tahun ini, itu cara hitungnya mungkin saja harus memakai GMM. Nah, tapi bisa juga kita pakai PAA. PAA ini untuk asuransi umum yang short term, yang biasanya lebih pendek dari setahun, atau yang long term juga bisa. Tapi ada syaratnya, dia itu harus lulus tes kelayakan PAA, PAA eligibility testing. Dia itu harus lulus dulu. Jadi di PAA eligibility testing, kita harus ngetes apakah LRC GMM dan LRC PAA memiliki beda yang tipis pas diukur. Kalau misalnya bedanya tipis sesuai dengan threshold yang kita sudah set, kita boleh pakai LRC PAA-nya. Tapi kalau misalnya jauh, misalnya kalau threshold Bapak Ibu set 10%, kalau misalnya beda jauh dari 10% harus pakai GMM. Nah, kalau misalnya 10% itu udah lewat, berarti mau nggak mau harus GMM. Nah, seperti yang kita tahu, kalau misalnya harus pakai GMM itu banyak prosedurnya ya, seperti yang sudah dijelaskan di sesi 2, harus ngitung PVFCF, harus ngitung risk adjustment, harus ngitung CSM. Nah, ini bakal repot cara ngitungnya ya, seperti yang kita udah lihat di sesi 2. Tapi semoga kalau misalnya Bapak Ibu bisa ngetes dengan benar PAA, ya bisa aja pakai PAA gitu ya. Untuk yang VFA itu biasanya untuk investment link. Investment link kita nggak bahas di sini ya, walaupun sepertinya di Indonesia bakal ada produk investment link untuk asuransi umum ya. Tapi sayangnya kita nggak bahas ya untuk sesi kita. Ya, jadi di LRC PAA kita nggak perlu tuh ngitung PVFCF lah, risk adjustment lah, contractual service margin, kita nggak perlu hitung. Kita cuma perlu hitung loss component, kalau emang ada loss component. Yang pasti kita bisa langsung hitung insurance revenue dengan lebih mudah, dengan lebih cepat, kalau kita pakai PAA. Insurance service expense, kalau ada loss component, berarti pasti nanti ada insurance service expense. Kalau misalnya PAA-nya long term, berarti pasti bakal ada namanya discounting. Nah, discounting ini bakal di-cover juga di insurance finance income or expense. Nah, ini yang harus diperhatikan ya. Oke, jadi learning outcome-nya ada 3 hari ini, yaitu kita akan cara menghitung LRC dengan PAA, terus kita akan menyiapkan account LRC menggunakan PAA, dan kita akan melakukan tes LGBT untuk PAA, tes kelayakan PAA. Nah, jadi di website kami sudah ada 3 Excel yang sudah bisa di-download oleh Bapak Ibu. Excel pertama, LRC PAA account for one transaction entry. Ya, ini contohnya. Lalu for whole portfolio juga sudah kita upload, dan ada juga kali ini ada satu ekstra ya, tidak seperti sesi-sesi sebelumnya, ada satu Excel ekstra, yaitu Excel untuk contoh tes eligibility for PAA. Nah, Bapak Ibu sudah boleh buka Excel-nya, 3-3-nya. Nanti kita akan kerjakan bareng ketika Jesse dan Nicholas akan menjelaskan cara mengisi Excel-nya ya. Oke. Sekian dari saya. Saya akan lanjut berikan sesinya selanjutnya untuk Nicholas. Oke, Nicholas, over to you.
Okay. Thank you, Billy. Good morning, everyone. So today we will discuss more about the premium allocation approach, or the PAA. So the main difference between IFRS 17 and IFRS 4 is that the insurance revenue is no longer the premium, but is the expected premium. So when it's expected premium, it requires some additional calculation. So in the PAA, the only thing that is important is this insurance revenue, which is different from the GMM method. So if you look at this, diagram on the right hand side, under liability for remaining coverage, for the part that is excluding the loss component, as Billy mentioned earlier, there is a GMM, PAA, and a BFA. So today we focus on the PAA. And for the loss component part, of course, when we use a PAA, there can be a unprofitable contract which will have a loss component, but that loss component is similar to what we have shown last week in the GMM calculation, so we will not emphasize it again. So under this PAA, what you will see that the main work that we will do is to calculate this expected premium. And when you receive a premium, we need to allocate it either according to a passage of time, which is similar to what you have in the UPR, like a 1/365 method, or an expected risk pattern. So expected risk pattern is quite relevant in the Indonesian market because you have some long-term contracts. So we will explain also how long-term contracts can be used in PAA, and long-term contracts, we may not expect that the risk is actually same every year. So for example, at the expiry of some of your policies, you may see sudden spike in the claim. So we need to, for those contracts, we may want to consider the expected risk pattern of this of the claims before to be calculated as part of the expected premium. So the disclosure requirement is actually same as before. So there will be an insurance revenue. We need to split this into loss component and the part excluding the loss component. There is also an OCI option if we want to apply discounting to our insurance revenue. So we will also show how we apply discounting to the insurance revenue, because for contracts that's more than
Hello?
Hi, Nicholas, can you hear us? I think Nicholas has some issue. Shall we wait, Billy? Yeah, he's disconnected. We can wait for a moment. Tunggu sebentar, Bapak Ibu, sampai Nicholas kita bisa connect kembali.
Can you hear me now? Sorry, I was disconnected.
Yeah, Nicholas, I thought I was disconnected too because you were freezing.
Sorry, I know I suddenly
please continue
from the screen. Okay, so
okay.
maybe I continue. So I think where I stop is where the disclosure requirements is. So you can see that we will show you the format of the Rrc account, and is similar to those that we have for GMM. So we need to split by loss component. We need to split the insurance finance income and expense, and also the other comprehensive income if we are discounting this insurance revenue. And then we also put in the cash flows in this case, which is the premium. Billy, can we go to the next slide? So I have one more slide before we start the example. So this is something that there was some questions last time about how to do PAA eligibility. So PAA is actually a simplified measurement model. So the default is actually the GMM. So we can choose to adopt PAA if we want to, and we can adopt PAA if we satisfy some of these conditions. So the coverage period of each contract is 1 year or less. If it is 1 year or less, then it's automatic eligible. If it is not 1 year, if it's more than 1 year, we can still perform the test to see whether it's eligible or not. So if it's less than 1 year, we do not need to perform the test. And then the second criteria is the measurement of the LRC would not materially differ from GMM. So including no significant variability in the fulfillment cash flow expected. So this part is actually a judgmental eligibility. So the first part is automatic eligibility, and it's very clear, 1 year or less. The second part we have to test. Okay. So we need to perform this eligibility analysis at the inception of the contract, and we must understand that this variability here actually will increase if there are, number one, if there are embedded derivatives. So embedded derivatives can come in many forms, but maybe not so common for the retail general insurance products. And then the other thing is the length of the coverage period. So if your coverage period is longer, that means your variability will be is likely to be higher because you have more uncertainty over time. So what are the steps that we need to do? First is that we must assess whether we want to use PAA or not. Is it suitable for us? The argument for PAA is that it is easier to calculate. The argument for using GMM is that there are some disclosures such as the contractual service margin. So the contractual service margin is your profit. So if you do not disclose your profit, then when people read the financial statement, they do not know how much profit you have, because the PAA method does not disclose the profit at the initial stage. You only wait until all the profit emerge, then only the profit will be recognized in your financial statements. Okay, so if you have decided that you want to use PAA because PAA is easier, the second step is to identify this coverage period. There are some contracts that the coverage period is not easily identifiable. Some of them is very short term. Some of them, like on-demand insurance, you do not know when the coverage starts, you do not know when the coverage ends. And then there are long-term contracts, and sometimes there are extension to the contract. So the coverage period sometimes not immediately identifiable. But for the purpose of today, we assume that we are able to identify the coverage period. Then the third one is we need to set the materiality threshold. So normally we try to set more than one threshold because this is subjective. You may think that this threshold is okay, but the auditor may not agree, or the regional office may not agree. So you want to set a few thresholds. We test it all out, and then we want to avoid that one of these thresholds is actually not doing very well, or not useful in terms of determining the materiality. So when you want to determine materiality, you actually need to have some consistency with the audit plan. In the audit plan, there should be a materiality that is stated. So examples is that if the annual revenue is bigger than a certain amount, so if annual revenue is more than a certain amount, that means this group of contract is actually material. If it's smaller than a dollar amount, then it's not material. It's okay because using this bullet point number 2 here, there will not be significant variability because it's not material, right? The second part is that we calculate the difference. So we calculate the LRC under PAA, we calculate the LRC under GMM. If this is more than Y, then we will have this will be a material and maybe materially different. Another option, which is number C, which is to calculate a percentage. Normally this percentage is simpler, but it's not so good because sometimes the percentage miss out the absolute amount. So it's not so good to do C without doing B. So all this percentage and dollar amount by right should be agreed with the auditor. And then we want to develop scenarios to assess variability. So the PAA eligibility is not only done at the base scenario, we have to assess a few scenarios. What happens if discount rate change? What happens if loss ratio change? What happens if risk adjustment change, and so on? Because all these things may affect the variability in the fulfillment cash flow. And then once all this is done, we must have a methodology, right? That actually we can implement this in practice, because we need to perform the ongoing testing. Every time there's a new group of contract, we need to have a test. So either we say that these new contracts are similar to the previous one that is already tested, so we don't test again, because it will get the same result, or we need to put them into the model and run the model and test to make sure that it is still eligible for PAA. So when we do the eligibility, we don't forget about the fifth step, because the fifth step is what you have to do all the time on an ongoing basis. So this process must be easy to do. So if you do not want to go through this process, then you can also elect for GMM. Some people will think that it's easier to do GMM because I don't have to do all these things. Some people will think it's easier to do PAA because these few steps are easy to do. So this is the difference. So maybe I pass to my colleague Jessie to take us through this one simple example of how to calculate the PAA, and then we will look at how to calculate PAA for group of contract, and then we will look at how to perform this PAA eligibility. We'll bring back the spreadsheet from last week.
Thank you, Nicholas. Can everyone see my screen?
Yes, Jessie.
Okay. Good morning, everyone. I'm Jessie from Nicholas Actuarial Solutions. Today, I will go through the Rrc account for a single policy using a premium allocation approach. So there are 4 scenarios in this spreadsheet. Today, we will focus on the first scenario and the third scenario, as the approach for the second scenario is similar to the first one, whereas for scenario 4, is similar to what Wai Chong has presented for GMM Rrc with loss component in the last sections. So you may try these 2 scenarios later, and we will upload the answers to our Actuarial website after this session. So for the first 3 scenarios, we assume that the contract is profitable throughout the coverage period, whereas for the fourth scenario, we assume that the contract is onerous throughout the coverage period. The coverage period of the contract is a year for all the scenarios that I mentioned earlier. So let's move to scenario 1. So for scenario 1, the policy start date is on 1st of January. Premium is 100. Since the contract is profitable, so we will set the loss ratios at 50%. So we assume that the premium is received at 1st of January. So as of 1st of January, we'll have 100 of cash in the bank. So we will also need to set up this 100 in the Rrc account. So half a year later, since premiums has received on 1st of January, so it's equivalent to 0 here. And we will also need to recognize the premium returns as insurance revenue. So in this case, we assume that the risk for the single policy is uniform. So the premium is earned by the passage of time. So in this case, to recognize the premium as insurance revenue, we'll use a premium, which is 100, to multiply by 0.5, since this is a half yearly valuations and the coverage period for this contract is a year. So we'll have 50 of insurance revenue, and this will be recognized in the revenue account. So let's move to the Rrc account. So the opening balance here is 0. Since this is an initial recognition, insurance revenue is 0 as well. By referring to the journal and through the journal that we made earlier, so we have 100 as cash. So we'll input this 100 under the premium received cash flow. So we sum up all the entry here. So the Rrc closing balance is 100. And this amount we will brought forward to the next reporting period. So as at 30th of June, you have 100 as our Rrc opening balance. The insurance revenue here will refer back to the journal since is at the liability side. Is at the debit side. So we assume that this 50 will reduce the Rrc account. So in this case, we will need to put a negative in front of the insurance revenue. So by looking at the journal, the premium received is 0 since we do not receive any cash in this period. So we have a 0 here. So the Rrc closing balance is 50. So let's continue with filling up the balance sheet and the income statement. So as at 1st of January, we receive 100 here. So we will put 100 at the asset side. So at the liability side is same as what you have done in our IC or GMM Rrc. So we will take the amount from the Rrc closing balance, which is 100, and insert it here. So as at 30th of June, since we are not receiving or making any payment, so we will still have 100 of cash at the asset side. At the liability side, we will insert the Rrc closing balance here, so which is 50. So let's move to the income statement. So for the income statement here, when we look at the journal, as at 1st of January, none of the items are in the journal. You hit the P&L. So in this case, we'll leave the income statements blank. So as at 30th of June, we will have 50 to be recognized in the revenue account. So it will be equivalent to 50 here. So in this case, we'll use total revenue minus the total expenses. So we'll have a 50 of profit in this reporting period for this particular contract. So as what I have mentioned earlier, we'll skip scenario 2 as the approach is similar to scenario 1. So let's move to scenario 3. So for scenario 3, the policy start date and the premiums are same as scenario 1, same goes to the loss ratios. So in this case, as at 1st of January, there's nothing in the bank. So same goes to 30th of June. So we'll just put 0 here and here. So however, since the risk has started in 1st of January, so we will need to recognize the expected premiums as insurance revenue. So the assumptions here are, we assume that the risk for this single policy is uniform. So the premium is earned by the passage of time. So we'll just use the premium multiplied by 0.5. This is same as what I've done for scenario 1. So we'll have 50 here. So let's move to the Rrc account. So the opening balance here is 0. Like what I've mentioned earlier, this is an initial recognition. Insurance revenue is 0 as well. By looking at the journals, since we do not receive any cash within this period, as we assume that the premiums will be received on 1st of September, so the premium received here is equivalent to 0. So the Rrc closing balance in this scenario as at 1st of January is 0, which is different from the Rrc closing balance as at for the scenario 1, as we have 100 here because we received the premiums at inception. So in this case, we brought forward the closing balance from 1st of January. So the opening balance here would be 0. And here we will do back the same thing. Since we recognize 50 as insurance revenue, so it will reduce the Rrc account by 50. So we need to put a negative sign in front of the numbers here. So we have negative 50. Premium received is 0 since we do not receive any premium within this period. So the Rrc closing balance here is -50. So let's move to the balance sheet and income statement. So in this case, as of 1st of January, the asset and the liability side both are 0. The reason is because we do not receive any premiums within this period. This Rrc, you also need to set it to be equivalent to the Rrc closing balance here. So as at 30th of June, since we are not receiving or making any payments, so the asset side will still remain as 0. Whereas for the Rrc here, we'll insert the Rrc closing balance from the Rrc account as at 30th of June, which is -50. So we have -50 at the liability side. So for the income statement, let's look back to the journal. So in this case, none of the items will hit the P&L at inception as the contract is profitable. So the journal here for the income statement here would be blank. Whereas for the income statement, as at 30th of June here, we will have 50 since we recognize 50 as our revenue. So we'll use the total revenue minus the total expenses. We'll have 50 of profit for this contract within this period. So the main difference between the scenario 1 and the scenario 3 are the timing for the premium received. So we'll note that the premium received does not affect the P&L as the profit made in both scenarios are the same, but it will affect the Rrc closing balance. So for scenario 4, like what I've mentioned earlier, we'll skip this as Wai Chong has presented this scenarios in the last sections is similar to the GMM Rrc with a loss component. So we'll upload the answers to our websites after these sections, and you may also refer to this tab for the summary of the results. So that's all from me. Is there any questions?
No questions so far. See, I think we can continue.
Okay, thank you.
Thank you, Jessie.
Let me share my screen here.
Not yet.
Now, okay?
Yeah, it's good now.
Okay, so this example similar to the previous 2 weeks. So this example will elaborate the previous simple example based on what Jessie has shown. So what we have here is we actually want to show you what happens when there is a premium of 9,000 received on the 1st of January. The valuation date is at the end of the year, and we have a 3-year policy term. Okay, so that means we receive one single premium 9,000, but this 9,000 is actually for 3 years. So when this is the case, we actually need to apply discounting to our PAA. So that's why I've prepared the discount rates here. So the first thing we need to do is we need to decide how does this premium, how is this premium supposed to earn over the next 3 years? So if we think that this will be earned uniformly in the next 3 years, so then it will be 1 divided by 3. But this is not. So the default method is to use a level earning pattern like this, which reflects that the risk will be even across the policy duration. However, the standard also require if that the risk is significantly different from this. So for example, if it is 10, 10, and 80, So most of the claims paid in the third year, then you cannot actually use the 1/3. You cannot use this allocation method by time. But for today's exercise, we will show what happens if there's a level claim, because later we also want to compare this with our GMM example last week, which actually used this level allocation of the claim. So in the first step, it's very simple. All we need to do is actually we want to get the premium. So the only cash flow that's relevant here is actually the premium. So we just take this from the premium, and this only happens in the first day. We have no other cash flow. So this is why the PAA is a bit easier compared to the GMM method. So we don't have to worry so much about the claims and the expenses and things like that. Then we go to the next step. Okay. So when we have a long-term PAA, what we need to do is we need to have this adjusted. We need to have this discount rate, which I put here, to create this discounting factor, and we need to have this earning pattern, which I've set out earlier. The objective of this is actually to prepare what we have called here is the total adjusted exposure. So we are adjusting the exposure both for the discounting as well as the earning pattern. So what we want to do is we want to make a pattern that reflects both of these. So we have here equal to the pattern divided by the sum product of row 10 and row 11. So this will actually give us the discounted exposure. What we are trying to do here is that instead of recognizing a revenue if I take the earning pattern and I add it up, I will recognize 100% of revenue, but I want to recognize more than 100% of revenue because I need to allow for discounting. So we start at the inception. Basically, what do we do is we take the premium. So the premium is an income. So the negative of LRC is a liability account. So we basically have increase this by the premium in the first day. And then what do we need to do? What do we want to do is we want to calculate the insurance revenue. Insurance revenue, basically we want to make use of this amount here, which is the premium fixed multiplied by this adjusted exposure that we have. So similarly here, so this will become our insurance revenue. Okay, so the reason this insurance revenue is higher than 9,000 is because we have allowed for discounting inside here. So then we need to apply the discounting. We need to calculate how much is due to the interest. So the first will be what we have at inception minus the revenue and add with the interest accretion. Okay. So we will take this multiplied by the interest, and then we will prepare the LRC account this way. So this will be the projection of the PAA from the first day. We start the account with our premium. We subtract it with the revenue and add with the interest accretion. So this will reflect. So this reflects the time value of money, and this is why the insurance revenue is higher than what is the premium. So for in the first day there will be the LRC will be 9,000, then reduce to 6,000, reduce to 3,000, and then 0 when the policy ends. Then after this, we need to go to the next step. The next step is because now we have a discounting, we need to actually calculate this change in the discount rate. So we have here we need to do the same thing, which so if at the end of the year the interest rate is 4%, previously this was 5%. So we need to recalculate this new total adjusted exposure. So this will affect our revenue, yeah. So you can see now with a lower discount, if the discount rate has become lower, the adjusted exposure is lower, and hence the insurance revenue will also be lower. So the insurance revenue will now, that we want to recognize at this discount rate, will be equal to the premium multiplied by this factor here. And then because of this, there will be a different interest accretion. And we have to recalculate the closing LRC. Yeah? So it will be the same method. Start with the premium minus the revenue minus the insurance revenue at the interest accretion. So so if we have a different discount rate, then of course the LRC pattern will be different, and we need to quantify the change in the discount rate. 2D60. So this change in the discount rate will be equal to D33 minus what we have here, which is without the change in discount rate. So because the discount rate has reduced, has reduced from 5% to 4%. The LRC also has reduced from 6145 to 6117 by this amount. So the last step actually here is that we want to extract the actual cash flow. So let's say that we indeed have received this 9,000 over the period, to make it simple, because this is the actual one. Sometimes for whatever reason, the expected amount that you receive will actually not be the same. But to make the example easy, we assume that this is the same first. So what we have here, this is our LRC account. So to actually complete this LRC account, so what we need to do is we fill up insurance revenue for this period, which we have done from step 2. So the reason this is 3304 is because we have got this from here, and this is a little bit more than 3,000 because we allow for the discounting. Yeah. Then the next thing, we take the interest accretion. We also calculated the change in discount rate, and we also calculated the premium received. So the other thing that we need to take is the closing balance from the step 3. So because this is after the discount rate has changed here. So then we will be able to complete this. So what we are saying is that we collect 9,000 of premium. 3,000 is the revenue. So this 3,000 is earned this year. And then about 6,000 is the remaining one to be earned in the next 2 years. The difference in between is because of the interest and the discounting. So I think this will be quite similar to the current UPR method, just that if this is more than 1 year, the discounting need to be applied. Okay, so the next part is we will do the same thing to complete the account. We want to make sure that we have the postings right. So this premium, so the premium received debit cash, credit the Rrc, but does not go into the P&L. Insurance revenue, which is for the PAA. So this is a credit to the this is a negative because it's to credit the Rrc. So we have a revenue in the insurance in the P&L, and then we have interest accretion, which is an insurance finance expense, and then we have a change in discount rate, which is a negative. Okay, so these are all the postings that we need to have, and over here we want to present it into the income statement. Yeah, so the insurance revenue we take from here. So I think this is still the description for the GMM. This one shouldn't be here, but it's still current service here. So we have 3304. There's no insurance service expense because claims is recognized in the LIC. So we have interest accretion, which is 450. Impact of change in discount rate into the P&L. So this is a minus. This is a minus. And then we have this profit of 2883 from this this profit of 2883 is basically recognized as a revenue and the insurance finance expense. So before any claims. Whereas on the cash side, on the balance sheet, we add the cash, and then we also add up the closing balance, which is the liability. So with this, so actually you can see compared to my example at the GMM, we actually complete this quite quickly, because actually what is required under the PAA is a lot less from the measurement approach. So this is actually the benefit. There are less steps, and in every step also there is less complexity. And in fact, if the PAA is a 1-year contract, then actually basically step 2 we do not actually need this discounting and interest accretion. Step 3 we also do not need this change in discount rate, and basically that to complete this simple example actually only take 10 minutes. Okay, so now the next thing that I want to do is to explain how this works together with the GMM, and how to actually determine whether it is eligible for PAA or not. Do we have any questions so far? But Ronnie,
no questions. Currently, there's no questions, Nicholas.
Should we take a break? Should we continue?
Okay, you want a 5-minute break?
Yes, how about we continue at 11 a.m. and we start with the PAA eligibility.
Yeah, sure. Okay, no problem. Oke, Bapak Ibu, kita saat ini break dulu untuk 5 menit. Nanti jam 11 pas kita lanjut untuk PAA eligibility. Untuk pertanyaan silakan disampaikan di kolom chat terkait sesi ini, atau mungkin kalau ada sesi sebelumnya ada yang masih ingin ditanyakan, silakan disampaikan juga. Terima kasih. Oke, terima kasih. Selamat datang kembali Bapak Ibu. Sebelum dilanjutkan, saya ingin mengingatkan bahwa link untuk presensi dan feedback telah dibagikan di kolom chat oleh panitia. Mohon diisi untuk keduanya, untuk link presensi dan feedbacknya, karena kalau keduanya belum diisi, nanti sertifikatnya belum akan diterbitkan oleh panitia. Okay, now Nicholas, you can continue for the PA eligibility test. Thank you.
Okay, thank you. Let's continue with the last part, which is the PAA eligibility. So our objective here is we want to compare PAA and GMM. What is the difference, and is this difference actually material? So as just now I showed in the slides, we need to go through a few steps. Here we will show the steps that are relevant to the calculation. So basically, what we need to do is I have this spreadsheet that we have compiled from the PAA spreadsheet earlier and the GMM spreadsheet last week. So we have this same premium for 3 years starting at 1st of January and then we are now at 31st December. But for the PAA eligibility, the valuation date doesn't matter. We want to conduct the analysis at inception. So what we need to have is we actually have this CSM systematic allocation ratio. So you can see that this is we want to release the CSM evenly over the years. This is what we shown last time. So and then we also have the discount rate. So this is the same example. This risk adjustment is the same as what we have in the previous example. So in the previous example, we have shown all this cash flow. So that there's a misconception that you do not have to prepare cash flow when you want to do PAA. That's only the case when it is automatic eligible or less than 1 year. If it's more than 1 year, you still have to prepare the cash flow for the purpose of the PAA eligibility. So for the PAA eligibility, you just have to do this enough samples, to cover the portfolio so that you can actually convince the auditor. So you may not have to do this for each and every single policy. So this is where there is the time saving. So we have to prepare the cash flow, premium, claims, expenses, and then also the risk adjustment. So because we need to calculate the GMM first, okay? So then we go to this base scenario. So so the first step, what we do is we extract the calculations from Rrc GMM. So this part over here is exactly what we have done in last week. So we just bring it back here. There's nothing new to do. We just want to bring back all the calculations here because we want to calculate the initial PBFCF. We need to calculate the risk adjustment and the contractual service margin and how it gets released over time. Okay, and then it's important to understand for loss component. So for loss component, you don't have to worry about the PAA eligibility because the loss component calculation and for both PAA and GMM is the same. So because they're the same, they cannot actually materially differ. So this one you don't have. So when we do the PAA eligibility test, you don't have to worry about the loss component. Even if you calculate the loss component, it will turn out the same. So what do we have here is that we can calculate the PBFCF. So for the first at initial, and then we do the same thing again. We calculate the PBFCF in the subsequent period. So we project the PBFCF, we project the risk adjustment, and we have the contractual service margin from here. So basically with this, we have LRC of GMM in the first year and the second year. So this is the projected value. We just extend the calculations that we had. So at initial recognition, because again, we are not interested in the loss-making part of the business. So when the business is profitable, the initial recognition at GMM is 0 because of this CSM mechanism. The CSM mechanism will delay all the profits, so there's no initial recognition. So we have this. So basically, after 1 year, our LRC for GMM will be 6,006.1. After another year, it will be 3.1. So this is similar. So this is the projected LRC which we add the PBFCF, RA, and the CSM. Then using the same method, we calculate the PAA. So this is what we have in the previous spreadsheet. So you can see that it is quite similar because as long as this 9,000 premium is spread over 3 years evenly, so it will be 9,000, 6,000, 3,000, and 0. The differences is because you may have some differences in the CSM release pattern. You may have some differences in the discounting. We will show that in the subsequent scenario. So after having done this, what do we need to do is that it's actually quite simple. We need to calculate the absolute difference and the percentage difference. So we want to know the difference of and then we also want to know the difference. So normally we would divide this by the GMM because the GMM is the starting point. Yeah. So in this case, the difference is only 1% or 30, 39, and 40. So we calculate this difference first, whether this difference is acceptable or not. We discuss later. So so the base scenario is not difficult to do. What is more challenging is that we have to develop the other scenarios. So we call this alternative scenario 1. And over here in this alternative scenario 1, we assume that a discount rate has changed. So if the discount rate change and the GMM and the PAA still give a similar result, that means there's no difference between GMM and PAA, so it's good. But if a change in the discount rate makes the GMM and the PAA very different, then this will be a problem. Okay, so what you can see is that we have the same calculation, but we just change the discount rate to 4%. Okay, but we must recognize that the interest accretion for the CSM is still using the calculation from the base scenario. The reason for this is because the CSM discount rate is actually locked in. So it does not use the current discount rate. So we still use the same CSM as before. Okay. So this is so what happens is that when we come down here, we have the initial PBFCF is still the same because it's already calculated. At the end of time 1, what happened is that the discount rate has changed. So we use 4% discount rate to calculate the PBFCF and the RA. So these are highlighted in red because they are actually slightly different from the base scenario. Okay, so what we want to check, the check that we have over here is that we can see that the PBFCF and the RA is different from the base scenario, but the CSM is still the same as the base scenario. So this is what happens when the discount rate change. So because of this, the LRC GMM will change a little bit. The CSM is the same, PBFCF and RA change, so the GMM change. Then the next part is the PAA. So we have actually calculated in the previous example, the PAA has changed because of the different discount rate. So we just take back the same results and put it in here. And then again, what we would like to do here is that we take the same formula into the alternative scenario 1 here. So you can see that when there's a discount rate change, the GMM and the PAA, the difference is a bit more. It's now 2 to 3%. So when it is 2 to 3%, then then the difference is more than the base. So actually, you realize that when we do all these alternative scenario, right? Normally the alternative scenario will give a bigger difference than the base scenario. So the base scenario is just a starting point, but it doesn't really use into the end because the alternative scenario will give a higher difference. So this is what happens when the discount rate change. We have a second one. in this second alternative scenario, so what we have done here is that we put the loss ratio change. Now, when the loss ratio change, right, we have to extract the calculation from the LRC GMM and recalculate the CSM. Because when there's a CSM change, when there's a change to the assumption, it affects the future, and this one will actually go into changing the calculation of the CSM. So what happens here is that over here we still take everything from, we still take all the same amount from the previous, but we want to recalculate this CSM here. So what we have done is that we have, when there's an assumption change, so we have assumed that the risk adjustment and the future cash flow has increased by 10%. Okay. So when this actually happens, what is straightforward is that the PBFCF and the RA, which takes this new cash flow, will actually change. But we need to make some changes to the CSM. What do we want to do is we want to have this assumption change here, which is which is the difference between the previous calculation and the current calculation. So this is the PBFCF in this scenario minus the PBFCF in the base scenario, and this is the RA in this scenario minus the RA in the previous scenario. So this assumption change will actually go into the CSM. So what happens here is that when future cash flow, so this is our goal, right? When the claims and the risk adjustment increase, our CSM, which is our unearned profit, it will reduce because now there is less profit available for the future. Okay. So we need to this part of the CSM is actually recalculated. So we want to maintain back the same. We want to maintain back the same systematic allocation ratio to release the new CSM because of the change in the assumption. So this is a release. So then the opening CSM will be reduced by this release in the CSM. So this CSM release here and this CSM release here, the calculation is the same. However, what happens is that if the assumption has changed, so now this portfolio is less profitable. When this portfolio is less profitable, the CSM will reduce immediately and there will be less CSM to be released in the future. So we now put in this as the new CSM to replace the old CSM. And hence the LRC GMM has changed because of the changes to PBFCF, RA, and the CSM. Okay. Now the LRC for the PAA does not change because as we see just now, PAA only depends on the premium and the discount rate. So if the claims is more by 10%, the PAA LRC does not actually change. So this is still the same amount as the base scenario. So with this now, we still want to take back the same formula and then we want to compare what is the difference. So when there is a change to the loss ratio, the PAA does not change, but the GMM change. There will be some changes in the PBFCF and the RA. It will be offset a bit by the CSM, but this will lead to a 3 to 4% change difference between the GMM and the PAA. So the GMM and PAA goes further away. So now the question is, are all these things acceptable? Can we still use a PAA in this example? Okay, so what we have done is we have summarized this into a summary. So what is required? So this is the base scenario. In the base scenario, we said that the difference between the PA and GMM is only 1%. In the first alternative scenario, we changed the discount rate. This was 2% and 3%. And then after that, 3 and 4% is because we have changed the loss ratio. So one of the things we need to do is we need to allocate a threshold. So there will be a total company threshold, and then this threshold, this materiality threshold, needs to be allocated into all the different portfolios. So let's say a threshold of 200 is allocated to this portfolio. So according to these differences, if 200 is allocated, the biggest difference is actually over here, 192, compared with 200. So it's still less than 200, then although this is different, but it can be considered not material. The other way is to allocate a 5% or a percentage to this. So if basically everything is less than 5%, then we can still use the PAA. But if the threshold is 2%, for example, then basically in alternative scenario 1 and 2, this will fail, and then we can no longer use the PAA. One of the good thing of alternative scenario 2 is that it actually can show you the difference, right, between the allocated threshold and the percentage threshold. So you can see that the difference in the first year is actually more than the difference in the second year. But the percentage, because it's expressed as the GMM at the year, the percentage here is 3%, here is 4%. The absolute amount here is 192 and here is 114. So because of this, there is normally a preference, at least for my side, to use the 200, the absolute amount, because sometimes this percentage can be very misleading. It can be a very, very high percentage just because the Rrc GMM is a very, very small amount, but actually materiality should be determined on the dollar amount. So if you complete this type of analysis for all your portfolio, and then some will show yes, some will show no, and then this will help you to decide whether you can use the PAA or not. But Ronnie, this is the end of the material today. Maybe we can go to any questions.
Okay, thank you, Nicholas, Jesse, and Billy, for the presentations. So, okay, I think we have the first questions from Parona. Is to Nicholas. How many scenarios that we have to run in order to confirm the eligibility? Is there any guideline or regulation to build the scenarios, or and what is the reference?
So for example, so there are a few things, right? One is how many scenarios. So this one is what are the things that can change. So the things that can change, that can affect this percentage difference change, is basically the discount rate, the loss ratio, the expense, or the risk adjustment, and everything that affects the cash flow. I think normally there will be less than 10 of these type of things that can affect the cash flows, and then hence the number of scenarios is actually quite limited. The challenge is actually what is the percentage stress that we actually want to apply, so that we can actually satisfy this eligibility. That is something that is subjective. So why do you test claims increase by 10% and not claims increase by 20%, for example? So what happens is that if claims increase until if, let's say, the loss ratio and the expense ratio go until 100%, so exactly at the border between loss making and profitable, at this stage, right, GMM and PAA is actually the same. If this thing is because your claims equal to premium, or your claims plus expense plus all the outgo equal premium, and income equal to outgo, so GMM and PAA is the same. So it depends how you want to what is the extent that you want to test, and this depends on the variability. So if your portfolio is stable, then you shouldn't be asked to test a very big change in the loss ratio. So because we want to know whether this can happen or not. So these scenarios needs to be something that's realistic, something that you think can happen in the future. And then the other problem is to test at which duration. Do you assume that the loss ratio will change after 1 month, after 1 year, after 2 years, and things like that? So if it is a uniform change, right, then normally if we test at the early stage, the impact will be the biggest, because you apply this across the board to all the future years. So we have to make some judgment as to what to test. Normally once you have this test, and we will actually go and confirm this with the auditors. Yeah. So you may want to have the input from your auditor before you finalize this test, because you want this to be something that they will agree. So there's no very specific guideline. The scenarios needs to be realistic, and then this is not something that we do one time and then it will definitely work. There will be subsequent discussion on both how to set the scenario and also what is the materiality. Because if you set the scenario like very benign, right? So let's say you test loss ratio plus 1%. If you do this, then and you insist on doing this, the auditor may say, I also want to reduce the materiality threshold and then consider the change is material. You see, so it works together. Right?
Okay, thank you, Nicholas. I think the next question will be from me. I was curious if the premium is paid or is settled on installment basis. For example, it's a 3 years policy, but the insured decided to ask the insurer to pay it every year. Should we recognize the accurate interest in this case?
We will still recognize the interest, but it will be on an annual basis. Yeah. So the interest calculation will take into account that your premium is receiving every year. Because the rule is like this. The rule is that if either the LRC or the LIC, if it's more than 1 year, then you should consider whether you need to use the interest or not. But for some of these business, like you mentioned, if it's every year instead of single premium, actually whether you use discounting or not, it may not be material. So anything that's not material, this is just the general financial reporting practice, right? Anything that's not material, you may not need to do. So if the auditor is satisfied that you apply discounting and don't apply discounting lead to the similar outcome, they may not ask you to do this. But if the cash flow is more than 1 year, then definitely you must apply you must somehow consider the interest and the discounting.
Okay. Okay. Thanks, Nicholas. The next question comes from Parnal again. I think it's continuing the first questions. How long should it be reviewed, or annually, or once in 3 years, or anything else?
Okay, so when you write business, once you write business, you need to decide whether this new business is a PA or GMM. So you need to perform this PA eligibility test every time. Depends on how you group the business. Some company group the business 1 year is 1 tranche. Some company group the business every month is 1 tranche. So every time you have a new group of these policies, right, you need to decide whether it's PA or GMM and whether it's eligible or not. But the thing is, if the business that you write is very similar to the previous one that you have completed the PA eligibility test, then the results of your eligibility testing still work. It still remains. You see, the issue here is what if the business you write is very different? If the business you write is very different, you have to do the eligibility test again, because the previous eligibility test that you've done is no longer relevant. The second thing is has the external factors changed, because the insurance cycle may have changed, so the loss ratios are different. The discount rates may have changed, so the previous eligibility tests no longer work, you see. So I think there's no one simple answer to this, but as long as the previous tests still apply, then you don't have to do it. So if I think the question is how often it should be reviewed. I think it needs to be reviewed every time you put in the business, yeah. But review doesn't mean you must make changes. Sometimes you just need to confirm that there's no changes needed.
Okay, thank you. I think the next question will be from me again, because I'm a bit curious. We know we are still in the pandemic situation currently, where I think in Malaysia and in Indo it will be the same case. There will be less mobility in the road, and which will lead to lower claims from auto, particularly. Yeah, I was curious. Do you think that kind of situation, if we already implement the IFRS 17 right now, do you think we should review again and try to see if the model is still eligible or not? Because it will be part of the loss ratio change.
So I think when we apply the IFRS 17, right, so one of the things that we need to do is we need to set all the assumptions relating to both the LRC and the LIC. So when we set these assumptions, of course, so for example, when you're performing your current reserving work, you would set some lower assumptions to reflect less activity in like motor business, marine business, and things like that. There's less claims. So so this assumption, so currently when you perform also the IFRS 4 work, you need to review your assumptions as it goes. I think this is no different compared to the IFRS 17. When the only thing is that you may be mindful, you may want to put some weights to the statistics maybe 2-3 years ago, because those are the loss ratio that you expect in the future instead of the loss ratios that you see today. In terms of the product design, it is still roughly the same. Is more of like there will be less claims, and also potentially lower claims inflation because the economy is not doing so well. Of course, the discount rates now discount rates after the pandemic may also be quite different. So when you do things like the financial impact analysis, because yes, it's supposed to be reflective of the impact on the day you implement IFRS 17, right? So we need to take this into account, and cannot assume that the current pandemic situation will continue.
Yeah. Okay, thank you. While we're waiting for other participants who wants to unmute and ask their questions, so I just want to, so the final version of this Excel will be put in the same folder in your website?
Yes.
Okay, so how long will it be put there before you're closing it, or it stays there forever?
Oh, the materials will stay on the website. We won't take it down anytime soon. I wouldn't say forever, Pak Ronnie, because maybe a few years later we may take it down. It will be okay, there.
But,
wow.
Okay, so we still have some times until the end of this week at least to check the material. Oke, Bapak Ibu, ada yang mau ditanyakan lagi? Silakan unmute dan boleh bertanya langsung. Kalau enggak, mau di chat juga boleh. Boleh terkait dengan materi yang di-share hari ini, atau boleh juga terkait dengan materi yang di-share di minggu-minggu sebelumnya. Karena ini pertemuan terakhir kita ya, sesi terakhir dari webinar ini. I think the next question, okay, will be from me again. And what can be a material difference between both methods in PAA and GMM? In your example today, you show that the change of loss ratio can change the LRC between PAA and GMM quite higher than the previous scenario where the interest rate is changed. Other than that, do you think only the loss ratio that can significantly significant difference between PAA and GMM? Or in particular, do you see any other components that can lead to this difference between PAA and GMM calculation?
Okay, so I try one example. Now this is increased by 50%. Okay. So just now I do is loss ratio plus 10%. Now it's plus 50%. So you will imagine that 10% is a stable portfolio. So we stress test it with 10%, and 50%, let's say, is a volatile portfolio. So when you have a volatile portfolio, you actually have a very big difference. So when the portfolio is volatile, the chance of it failing the PAA eligibility is higher. Because to reflect why this portfolio is volatile, we will have the auditor will ask you to test a higher loss ratio percentage. Okay, I try another one. Maybe I try like this. Yeah. So I have to change this one to. So what I want to do is I want to increase the cash flow by 1 year. So let's say if this is instead of 3 years, this is 4 years. So we just have another year of cash flows. Okay, so I think what I want to show is that if we have another year of cash flow, what will happen is that so we will start with 9,000. Then we will have this initial, and then will be 6,000, 6,450, 4,500, and then another 2,250. Yeah. So let's say this will. So let's say this is a proxy to my PAA. So you can see that. There will be a bigger difference when the duration become longer. Of course, I just quickly make up this PAA. Yeah. So if this is, for example, if this is a 10-year policy, why will it fail PAA? Why will it fail PAA eligibility? The reason is because when the same discount rate change, the impact is a lot more significant. So two things are the duration and also the volatility of the portfolio.
Okay. Yeah, I think we have some challenge because in non-life business here we have long policies, particularly for home mortgage insurance. yeah, it goes up to 15 and 20 years.
Yes.
So it's something that
that one is actually challenging because the problem is that it's quite hard to tell what is claims in 20 years time, because you have to project the property value also. You have to project all the cost of the materials, etc., to be able to understand what is the claim in 20 years time. So because if we do that, that is actually something that's kind of complex. The other thing that I understand that potentially have an issue in Indonesia is actually related to the PAA, to this systematic allocation ratio, right? So this kind of formula only apply if the risk is uniform, but sometimes the risk is not uniform over time, and we may not be able to actually give a very good statistical analysis on how the risk change over time.
Yeah, yes. Okay, it's good for me. Thank you, Nicholas.
Okay, thank you.
Ya. Oke, Bapak Ibu, ada lagi yang mau ditanyakan atau disampaikan? Okay, I'll take it as a no. So there are no more questions, Nicholas. You're lucky. Thank you for today's session, and thanks a lot for these 3 sessions, and we really appreciate your support. And ya, untuk Bapak Ibu, sekali lagi saya ingatkan untuk mengisi link absensi yang telah di-share di kolom chat, dan juga untuk link feedbacknya mohon diisi juga, karena kalau keduanya belum diisi, baik itu link absensi ataupun feedback, maka sertifikatnya tidak akan diterbitkan oleh panitia. Mungkin itu sekian. Sekarang akan menutup acara ini. Sebelumnya terima kasih sekali lagi saya ucapkan ke Billy, Jesse, and Nicholas. Thanks again for the support. Dan juga pada para peserta untuk partisipasinya selama 3 sesi ini. Harapannya kita setelah workshop ini, proses implementasi di perusahaan masing-masing, khususnya untuk perusahaan yang di asuransi umum, bisa berjalan dengan baik dan lancar ya. Khususnya dari sisi aktuaria, karena kita sendiri sebelumnya mungkin banyak bingung PAA eligibility test itu kayak gimana sih implementasinya. Karena kita harus terapkan JMN dan PAA, harapannya setelah ini kita bisa mulai lebih mengerti untuk melakukan implementasinya ya. Terutama kita akan sampai pada tanggal implementasi PSAK 74 itu di 1 Januari 2025 ya. Akhir kata, mohon maaf juga apabila ada kekurangan selama acara ini berlangsung, dan semoga Bapak Ibu dan teman-teman semua selalu diberikan kesehatan selama masa pandemik ini, dan semoga kita dapat melalui dengan baik ya.
Foto dulu Pak ya?
Ya Pak, untuk menutup acara ini, seperti yang disebutkan di awal, kita akan melakukan sesi foto bersama ya, yang akan dipimpin oleh Pak Yosef.
Oke, terima kasih Pak Roni. Baik, semuanya bisa diaktifkan terlebih dahulu kameranya. Di sini ada 6 slide ya, berarti ada 6 kali sesi foto. Oke, yang pertama 1, 2, 3 senyum. Oke, terima kasih. Yang kedua 1, 2, 3 senyum. Oke, terima kasih. Yang ketiga 1, 2, 3. Oke, keempat, waduh belum pada buka. Oke, kelima, dan terakhir, ya, terima kasih.
Oke, pesan terakhir, sorry, ada ini yang mau saya sampaikan terakhir. Per hari ini kita sudah, PAI sudah membuka link untuk pendaftaran Joint Regional Seminar yang akan diadakan pada bulan September. Pada tanggal 8 September dan tanggal 13 September untuk lokal programnya. Jadi teman-teman atau Bapak Ibu yang ingin mengikuti Joint Regional Seminar ini, dipersilakan untuk websitenya CPD PAI untuk mendaftar, dan SKP-nya itu 6,8 SKP ya. Pendaftarannya akan ditutup pada tanggal 6 September, jadi silakan Bapak Ibu untuk mendaftarkan diri sebelum tanggal tersebut. Oke, sekali lagi terima kasih untuk Bapak Ibu, salam sehat semuanya. Selamat siang.
Selamat siang, terima kasih banyak.
Selamat siang, terima kasih banyak.
Selamat siang, terima kasih.
Selamat siang, sehat-sehat
Terima kasih.
selalu.
Sampai ketemu lagi di
Thank you, Mo. Oke, thank you Pak Yosef, thank you Pak Handayani sama tim PAI. Saya izin live dulu ya.
Ya, terima kasih Pak.
Terima kasih, Pak Rodi. Terima kasih, Pak.
Ya, makasih Pak.
Terima kasih semuanya.
Ya, terima kasih Pak.
Terima kasih, Pak.